What's going on, guys? It's Jimmy here. Welcome to our daily show where we discuss everything going on here in our country that you need to know about here on a daily basis. And we are already seeing the housing market collapse here in the United States because of how high interest rates are getting. And we're going to see probably two more interest rate hikes here this year. And it's not just the housing market, but this is affecting everybody as credit card interest rates are now the highest they have ever been in the history of the United States and really the entire world, as interest rates are going up all around the world as well. And at around 19% as the average interest rate. Also, the highest credit card interest rates are right now about 35 or 36%. Yeah, absolute nightmare there. Which means if you have about a 20% credit card interest rate, that means you're paying about 20% of your balance every single year just in interest. That means every 5 years, you're paying the entire amount you owe in interest. So if you have a $10,000 credit card balance for just a round number, it means you're paying about $2,000 in interest every year. So over 5 years, that $10,000 that you owe, over 5 years, you're paying $10,000 in interest over 5 years. And you still owe the $10,000 in debt. This is how credit card companies and banks make billions of dollars. If you're paying a 33% interest rate, because remember the highest are 35, 36%. If you're paying 33%, that means every 3 years, you're paying the entire debt that you owe just in interest. Just in interest. Yeah. So just kind of think about how bad these credit card interest rates are. And they're going to continue to go up because interest rates are going up again in November and December. Yeah. And now, to make matters worse, we're seeing a collapse in the housing market as well. We're really just seeing the economy kind of crumble here. And it's not just the U.S. We're seeing this pretty much all around the world. Remember that. So the U.S. has 8.2% inflation. That's the core, the overall inflation rate. Some things are higher, some things are lower. The Social Security, their raise is 8.7% because it goes off a slightly different index, CPIW, instead of the core inflation. But the UK, the United Kingdom, their inflation's at 10.1%. Most of Europe's around 10%. Canada's around 7%. So this is pretty much everywhere. Doesn't make it better, but just kind of shows you what's going on here. Here, take a listen at this.
Diane. But Steve, let me start with you. And look, this is a case where voter sentiment about the economy and where the economy is headed are actually in sync, correct?
Potentially, yeah, to the extent that people are worried about a recession. It is a abiding concern of economists, forecasters, CEOs, Federal Reserve officials. Kind of interesting that such a small percentage think we're in one now. There's a lot of talk about are we in one yet, but 59% think that's to come, which is not a very good number. And Chuck, I want to say you were spot on starting with housing because, you know, I've been doing this poll for 14 years, which is ridiculous to think about it, but nothing colors people's attitudes about the economy as does their views about housing. The 23% who think their home is going to decrease, that's the highest level since 2008. That's the financial crisis. And the percent who think their home is going to increase, just 32%. That's the lowest level since the pandemic. So I think you're right to focus on housing and the importance of that for people's attitudes on the economy.
Well, Diane, that is why you're here, because, look, gas prices may be the billboard people see. Boy, things are getting more expensive. But when it comes to sort of feeling, what is your financial feeling on financial security? The biggest check you write every month is either for rent or a mortgage. And this is where you come in. You were sounding the alarm bell. You're fearing that the housing market is crashing.
It is crashing. And, you know, what's really, it underscores is how It is. We've seen rapid rate hikes, not just rate hikes on mortgage rates. They've been rapid rate hikes. And that's even more destabilizing than just moving up rates. And I think it's something that the Fed has understated in their own views in terms of how rapidly it's taken a toll on the housing market. And what's interesting is we're seeing also some of the hottest markets in the country are now beginning to cool on prices despite still really constrained supplies. People aren't willing to sell out of those 3% mortgages that they locked into a year ago and put their houses on the market. And so we're not seeing the downward pressure on prices that you would normally see from a surge in an excess supply of people trying to sell homes. You're seeing it from the fact that houses are just unaffordable.
So we're in this weird period on housing, Diane, where we actually still have a housing crunch in this country. So that's also causing some price pressure. Get consumer-y here, sort of consumer help here for a minute. If you're thinking about buying a home, you saved some money, you were thinking about buying a home, I take it this is about the worst time, or is it going to get worse and you better just jump in when you can?
Well, you know, I think it is unfortunately a bad time at the moment, and it is going to get worse. It will eventually get better, but we've got to get through a very rough time before we get there. And that's the hard part. And of course, the flip side of this is, you know, it does also increase demand for rentals. And so even though rents on the margin have been coming down, many people are paying more for rents, and it's forcing them to stay when they would like to buy a home. So it's very difficult. But I think what's really important about what's going on is we've yet to see national housing prices decline. And I think next year we will see them decline by a double-digit rate. Now, it's not the housing bust. It's not the subprime crisis. We've still got skin in the game. But those are important wealth effects for every household out there. And so if you're not feeling as good about the value of your home, you're not going to be as willing to dip into savings, which you've already dipped into quite a bit if you're a middle income or lower household. It's all that excess saving is piled up in the very wealthy households. That doesn't keep the economy going, and it doesn't keep very many people happy.
You know, Steve, I feel like the Fed has this thankless job. They only have one tool, and they're going to keep pounding it and pounding it and pounding it. They're going to, and I understand it from an economist point of view, but it seems as if there's some things that they haven't been able to account for. We're still spending money. We're still consuming. We're a consumption economy. What's happening in housing, do you think it's at all going to make the Fed rethink this next interest rate hike?
I don't. And just a little pushback on my good friend and pal Diane Swank on this one issue. People still have considerable gains in their homes, and we haven't really seen a big decline. It is interesting, Chuck, there's been some research that shows people really know what their house is worth at any one moment.
Yeah, go to Zillow.
And
Zillow tells you all the
time.
Yeah.
You can go to Zillow, but people also have in their brains because they know what's going on in their neighborhood. It's something they really do know and pay attention to. I think what's happening in housing right now is a reason for consumer caution, but not yet panic. We haven't had a big, as Diane said, a big housing crisis or decline in prices as we've had in the past. The Fed wants to see it cool off, in part because, Chuck, this is low-hanging fruit. Housing is such a big part of the CPI that if they can get some help there on housing prices, it'll help bring down the whole CPI in a way that would reduce inflation overall.
Yeah, you could see here, buckle in for a brutal free fall in home prices as U.S. housing is in for a massive bubble, experts say, as we have seen a massive run-up in housing prices. And now they think we're going to see a massive fall in housing prices because of how high interest rates have gotten and how people don't want to sell for people that have those lower interest rates. Another massive headline here today, U.S. home prices could fall as much as 20% in the next year. Quote, we expect home sales to keep falling until early next year. By that point, sales will have fallen to the incompressible minimum level, where the only people moving homes are those with no choice due to job or family circumstances. Discretionary buyers are disappearing rapidly in the face of the near 400 basis points increase in rate over rates over the past year. Basically an almost 4% interest rate rise already. And remember that We're going to be seeing probably 2 more interest rate hikes this year, November and December. And then we're also going to probably be seeing more interest rate hikes next year as well. A lot of people think this is too much. At first, the Fed was, remember, the Fed is an independent organization. They're not, the Fed head, Jerome Powell, is a Republican that was appointed by former President Donald Trump. But technically, they're independent from the government. So even Biden has said, let them do whatever they need to do. They're doing whatever they think is the best to help try to bring down inflation. But now a lot of people are saying, well, at first they were criticized for being late to the game to stop their monetary stimulus bond buying, which is a different type of stimulus. It's a government bond buying into the markets. They had to basically reverse course, stop that, and then raise interest rates. They were criticized for doing that a little too late. Now they're raising interest rates almost what some people are saying too fast, too quickly, and they say they're going to keep rates higher for longer. And already people are starting to feel the pinch. Credit card interest rates already at an all-time high. Yes, credit card interest rates reach new historic highs. The average annual credit card interest rates just under 19%. That's affecting anybody with credit card interest. Mortgage demand drops to 25-year low as interest rates climb. So the amount of people that are buying new homes already at a 25-year low. So we're already seeing a massive drop there. And mortgage demand, new low as a 30-year interest rates on mortgages now average over 7%. So they were under 3% or around 3%. I think we were under 3% at one point, which was unbelievably low. Hopefully you locked that in or got anywhere close to that. Boy, those were the good days. I did lock in there. Yeah, now 7.1%. So over double already. We have gone up in less than a year, basically. That is unbelievable. Unbelievable. That's, yeah. Now, on the flip side, treasury bonds, for people that, put some savings money into treasury bonds, those are the highest level in 14 years, paying up 4.3%. Still not that much, right? So this is where like the rich get rich and the poor get poor. Credit cards are making you pay 19, 20, up to 35%, where your savings, if you're putting savings in a bank or in a treasury bond, paying 4.3% or even less in a bank account, right? This is where this is why people put money in the stock market. The stock market's been rough this year. It's negative this year. Last year was the S&P 500. The S&P 500 stock market index ended 2021 with nearly a 27% gain. This year it's down. This is how the stock market is. It's up, it's down. Most years it's up, but this year is a down year really because the economy is just not having a good year. And we have given up all the gains back from last year. We're at about a 2-year low. We have actually seen significant gains up here recently in the last week or two. If you look here at the Dow Jones Index, we've gone up 31.3. We've gone up about 1,000 points in the last 5 days. Now, whether or not it's a temporary bounce or not, still hard to tell. Stock market is really a long-term investing play. If you're scared of every up and down, might not be the right place to invest, because you have to look at it as at a long term, even over a 5-year play. 5 years ago, the Dow Jones was at 23,000. Now it's at 31,000. I don't know what percentage that is, but that's still like a 40% return. And over a 30-year time frame, which is like a investment time frame for retirement, you might put your money in there for retirement. 30 years ago, the Dow Jones was at 3,000. Now it's at 31,000, despite the big drops that we've had here since the pandemic and the last year or two that everybody's all concerned about. The stock market, the Dow Jones Index has gone from 3,000 to 31,000. So that's kind of how your money grows, where like in comparison, the credit cards are taking 20 or 30% interest from you. Yeah, so that's why the age-old saying of the rich get rich and the poor get poorer from you. Um, that's why it's a tough game if you're stuck underneath that credit card debt, especially right now, because credit card debt is going to get more and more and more expensive, and it really already has. It's already gone up several percentage points this year, making it more and more expensive to pay off, especially if you're anywhere over that average percentage. If you're even anywhere near 20% or more, it's going to be very, very expensive to pay off. So one of the strategies to try to pay something off is called the debt snowball, um, which I've seen a lot of comments in the comment section. People really like this strategy. Is try to pay off your lowest balance card first. Okay, don't even look at the interest rates, because that's another strategy, is pay off the highest interest rate one first, which makes the most economic sense. But the problem with that is your highest interest rate card could have thousands of dollars of balance. Okay, the debt snowball strategy is take your lowest balance card. Maybe it's 100, 200, 300, couple $100, whatever it is. Okay, and just work on paying that off. Okay, this way you can pay that off in a short amount of time, several months, whatever it is. Then when you have that completely paid off, just cut that card up, put it in a safe, whatever you want to do. Remember, if you close the account, you may or may not want to do that. It depends on you. But you'll probably take a little bit of a credit hit. Okay, when you close an account, your credit will drop a little bit. Your credit score. Okay, so that's up to you. But you got to kind of resist that temptation to use it again. If you do use it again, pay it off in full every month. Just what some people do is they'll set it to pay off automatically, take the money out of their checking account, and you could set it to pay in full. Make sure you have enough money in your checking account. Okay, if you pay in full, you don't pay any interest when your bill comes due. Okay, and some cards give you rewards. So if you charge $100, $200 a month, whatever it is, you pay in full. If your card has rewards, they'll actually pay you to use the cards. Really cool. But once you pay off that card, if your bill was $50 a month or whatever it was, $100 a month, whatever it was, you don't have that payment at all anymore. So then you can take that payment and use it and double up towards the next lowest balance, because now you no longer have that payment. So we'll just say that payment was $50 a month. So now you can take that $50 and apply it towards the next card as well. So you have that 50 and the other 50. So now you can make double payments on the second lowest balance card. So you can make double payments on that and then go towards paying that one off. So you can pay that one off twice as fast. And then again, that's the second lowest balance. So you can pay that one off twice as fast. And when that one's paid off, you can be like, wow, we've paid off two cards. And the key here is that you're taking the lowest balance cards so that you pay them off quickly. You get those quick wins. And when you get those quick wins, you're like, well, first of all, this is awesome. I've paid off one card, and then I've paid off two cards. And then when you've paid off these cards, you no longer have those bills. The key is to not take that money and spend it on something else. You take that money and move it towards paying off your next card. Because you got to remember that paying interest on these credit cards is like taking money and throwing it out the window when you're driving on the freeway. Okay, because they're charging you interest every single month. So when you go and buy $100 on the grocery store, it's really like spending $150 or $200 for the exact same food because they're charging you interest every month. So you're actually paying more money for the stuff that you're buying. Okay, so you're not actually ahead of the game, you're actually paying more. So this is why credit card interest is so deadly. So let me know your thoughts. Do you have any other strategies or anything that has worked for you? I have seen some comments here recently. Some people said they paid it off completely. They paid off everything completely. So let me know what worked for you here in the comment. And remember, please remember in the comment section, don't call or text anybody from the comment section. If you see my picture in the comment section saying call or text me, it's not me. It's a scammer. We have scammers all the time that try to copy my picture and act like they're me. I don't have any phone numbers for you to call ever. I don't have no phone numbers to call. If you ever see anybody saying call or text me, it's not me. It's just people impersonating me. Okay. If you ever see me in the comment section, I'll always have a check mark by my name. Okay. And if anything, I'm always just saying, God bless you, or I'm just commenting or something. I never have a phone number or a text message ever. I just don't have anything. I don't have time to call or text people by the hundreds of thousands of people. Okay. So keep that in mind. But if anything, what you can do, click the subscribe button and the bell icon down below. It's completely free to do so. It just makes it so you're more likely to see our new videos here on YouTube. It costs nothing. Remember that new videos come out here on our YouTube channel every day at 10 a.m., 3 p.m., and 8 p.m. Eastern Standard Time. Every single day. This is literally every day. So if you're not getting our notifications, or if you don't remember, our new videos come out here every day at those times. If you're not getting our notifications, it's probably because your phone or your device, you don't have notifications allowed for YouTube. So you can go into your notification settings on your device or on your phone and just allow notifications for YouTube, and then you'll probably start getting them. Okay, so here's some videos you can watch next. You can click here to watch my newest video on checks that are actually going out here in the next few days to millions of Americans. And here is my newest video on Social Security raises and dates coming out here for that. So click on one of those videos next. Thanks for watching, guys, and I'll see you in the next video.